You just have to be authentically you. I think I also was authentically me too late in life. I was just when you're young, you just want to make everyone happy. You want to fit in, you just...
Worried about what people think about you.
It's really tough. And then your authentic voice doesn't come out and you're just upset inside. And I don't know, being an entrepreneur, I do think it's an opportunity for you to step outside of wherever you work today and craft something that's uniquely you.
Hello, everyone, and welcome back to the Traversing Entrepreneurship podcast, a show for business owners who set out to do something different and did not stop there. This is Derek DeLomo coming to you from Traverse City, Michigan, the city that inspired the name of this show. With over 17 years of experience in the financial industry, I've heard my fair share of success as well as horror stories in business. On this podcast, I enjoy sitting down with a variety of entrepreneurs to talk about what it takes to build a successful business, including all of the ups and downs that come along with doing something different and paving your own way in life. In today's episode, I'll be interviewing Brad Zapp, a certified financial planner out of Kentucky who has now founded Kinetic Ventures, a digital venture capital firm that uses AI to vet opportunities. He is also the former founder of an independent wealth advisory firm. Join us today as we discuss his shift from wealth management to venture capital and the perspective that shift has given him. We will also discuss the importance of perseverance, the promise of mistakes along the way, as well as the role of luck, mentors, and resource allocation in achieving success. Welcome to the show, Brad. Thanks for being here.
Hey, Darren. I'm very excited to be here on your show, particularly as a current certified financial planner, but former advisor. It's good to sort of be amongst my people.
Yeah, for sure. So, on that note, can you give me and our listeners an idea of how a former wealth management person made the transition to now owning a digital venture capital firm? What was that kind of path like? How the hell did you get there?
I didn't mean to. It's like a series of unfortunate events followed by some, chance encounters and good luck. But I think if you want to think about the cornerstone of the way I think about the world, it's important to know, when was I a financial advisor? So I entered the industry in 2000, which in modern history, 2000 to 2010, people call it the lost decade. Probably the worst time to be a financial advisor in modern history. And so from the day I started in the industry, I didn't see the stock market make anybody any money. It went straight down. So first we had the .com bust, and then, 2000, 2001, 2002. And by summer of 2007, when we started to get our money back, we had the Great Recession. And going through those very difficult times, I learned to cut my teeth under live fire, and I became just passionate about alternative investments. And if you think back, 20-something years ago, alternative investments back then was real estate. And real estate wasn't even that popular because it didn't serve as a buffer during the Great Recession. So I always was interested in anything when alternative managers, private placements would come across my desk. If it was not stocks and bonds, I was super interested in it, right? And so by the end of my career, the challenge I had, which a lot of people have to this day, was even if I found something that was super interesting, even if there was an investment product or investment strategy that I was like, what, this belongs in my portfolio, I couldn't apply it across every client's personal positions. Mm-hmm. And there were a couple reasons that you couldn't do that. So reason number one is most of these were accredited investors. And so while most of my book of business was accredited investors, they weren't all accredited investors. So there's a whole chunk that couldn't do it. Then if you look inside, my book of business, and most advisors may feel this way, even when you were accredited, my book of business was closely held family business owners. And so, these were people that their net worth was being reinvested in their business. And the investments I had was traditionally retirement accounts, 401ks, rollovers, stuff like that. And so when you're going into a private placement, these are pass-through entities. They would do K1s. You might have some adverse tax consequences if you put those in an IRA. And so they didn't like to do that. So put that on the shelf. And then the third barrier to entry was if I get through all that stuff and I had a group left, the minimums were too high. So just think how much money you'd have to have if you wanted to put 10 different alternative strategies inside a client's portfolio, and the minimums are $250,000.
It's $2.5 million.
It's unrealistic for 98% of the United States. So by the end of my career and getting through the Great Recession, some of my alternative strategies did extraordinarily well. So I had this real tiny percentage of my book of business that thought I was a genius. And then I had this large portion of my business that either thought I was just like everyone else or I was, a dux. But neither was true, right? I mean, it was supposed to be the same experience for all of my clients, but there were all these problems that you could only sell stocks and bonds. And so that was very frustrating. And by the end of my career, I sold my company and I set out to sort of, solve that riddle. Could we make, better alternative investment products that I could have said yes to as a financial advisor, and in a perfect world, push a button and allocate it electronically across my book of business so everyone has that homogenous experience. Everyone has a true diversifier play. So I sold my business, in 2014, and I started my journey in 2015 into the venture capital space. I could have chose a lot of different things, but I chose that for varying degree of reasons, but that kind of started me on this path.
And so I guess for anybody that doesn't know listening, how do you define venture capital space? Everybody's got their own kind of, I'm going to say, play on VC or venture capital. What is it for you?
So a couple of definitional guardrails to know, is this really venture capital? So first off, private equity is the large asset category. So those are, companies that just aren't traded on the stock exchange. That's the whole kit and news. 7 million or so private companies in America. Maybe there's 4,000 publicly traded companies. So private equity encompasses the other 7 million, which, by the way, if you don't have private market access, that's a really big sandbox not to be playing in.
Yeah.
Venture capital is a subset of the private equity, and it's basically business model and financing driven. So private equity, some hallmarks that you would see about that is they're usually older, more established companies that have a longer track record and are probably profitable from a bottom line standpoint. And they could be service companies or product companies. Some hallmarks of pure play venture capital. Venture capital would have, they can be large, but they would have got there very quickly. They would have not a long history. So these are newer companies. There's a heavy tilt towards an innovation or technology. It could be an innovative business model, like Uber was an innovative business model, peer-to-peer, taxi driving, or it could be a technological, innovation. Typically, these companies need to finance that technological innovation, and there's not a financing mechanism out in the traditional world today, like banking or bonds, that can underwrite these deals. Right? Banks are really good at lending against buildings and a balance sheet. They're not so good at building, anymore at funding, corporate ideas, out into the future. Yeah. So venture, that created the industry of venture capital, which, a founder, it can be an idea, it can be a little more progressive than an idea. But again, it's this company that believes that they have a technological advantage or an innovative advantage, that if they can bring the market, they can capture market share. But they need a venture capitalist. So VCs are often referred to as at-risk lenders. Banks are no-risk lenders, right? The good side is people say, well, venture capital is risky. And I would say, yeah, but there's a balance. The other side of a risk is reward. So we take equity ownership. So when that founder goes to the moon, we go with them. And you would never see that in the banking industry. So again, to recap, it's private companies. These are innovative product, highly innovative, highly technology driven, and they need to finance that technology, and venture capitalists provide the financing to them.
Are they generally So they're financing the, let's call it the technology build out, or are they financing kind of the technology spread?
Both. So
Okay.
it depends on the stage of the venture capital firm. And so they all, unless it's self-funded, they all need financing. So
Yep.
it could be really early stage, and that's where the founder, maybe they've set up their company, maybe they've got a co-founder, but they've built a minimum viable product, but they really don't have an enterprise ready product. So you could finance that build out. And when you go that early, you pay less. So you get more of a company. So it balances out. If you wait and you want to finance the next phase, because let's say I go in early and you tell me that you've got this new tech platform, for financial advisors that's going to change the way we report, bill, and monitor, and it's driven by AI. And I'm like, wow, it's amazing. I want to be on the early stages. And I'm like, here's $1 million, and you use all that money to build the company. Well, then we need to distribute, right? We need to market, acquire customers. So the next phase is kind of like, the expansion phase, or some people call it the growth phase. And that's where we're out really trying to acquire customers. Now, you come in that phase, you don't have the product's built, you can touch it, you can feel it, you can do due diligence, but the company is de-risked a little bit. And so you get it's a little more expensive. I get a little less of the company when I financing. And this goes on and on and on, all the way to IPO.
That is the end goal then of pretty much every VC company, is to IPO or sale.
I would have said years ago that probably was true. When entrepreneurship, if you go back 20 years when I was a financial advisor and you looked at the degree programs to universities, I'm not sure how many nationwide had a degree, major or minor, in entrepreneurship. So entrepreneurs, we just sort of accidentally, became entrepreneurs. It wasn't something that I thought about becoming. I wasn't taught how to do this. Fast forward to today, I would say the majority of accredited universities have a program, if not a, master's, major degree or minor in entrepreneurship. So you have, hundreds of thousands of students at least considering, this field of entrepreneurship. So that skill set is spread, like a forest fire from Silicon Valley all the way across the country. Mm-hmm. And in our sort of, experience over the last decade is, I think, behaviors of people in Ohio or Kentucky might be different than Florida, might be different New York, might be different than California. So I do think there is a playbook and a strategy for IPO, but I think, from a venture capital standpoint, there's also successful outcomes that don't result in the IPO. The company could, raise less money and therefore, get to, maybe profitability faster and, can just send out checks to shareholders. I mean, I think we've seen that, especially on our consumer products divisions, or you could sell to a strategic or merge with another strategic. I think there's a lot of different outcomes today that probably weren't, as IPO or bust, maybe more so in the past.
Right. So you've done this for, I call it 8-9 years now. Over the course of Kinetic Ventures, I guess, what would you put out there? And everybody defines this differently, but what would you put out there as kind of the top 1 or 2 major successes that you've had? I mean, so first of all, how do you define success? And then, what would be the top couple of success pieces that you can point to over the course of your, 8-9 years with Kinetic?
So for us, look, we're an institutional investor. I mean, our goal is to place money in deals that needed the money and get it returned to us. Now, venture capital's overall return on a portfolio, we're not like a bank where we need every deal to go well, right? Or we repossess something. We price in the deals that go bad. And so, it could be like a third. If a third go to zero, a third break even, and a third, get some multiple our money. That works for us on the overall portfolio. But without saying some names, I mean, so success is, 10x, getting a big lick, right? This is I have a friend of mine who's another VC, and early on I was like, yeah, we need to get some home runs and show some returns. And he said, Brad, he said, you've got this all wrong. He said, this ain't a home run business. This is a grand slam business. And
Okay.
he'll see this and he'll know who he is. And you know what? He's right, because that's really what you need is you need to get those, grand slams and return multiple runs, in order for this to be profitable. That's success. Look, we're a financial institution. And so success for us overall is to be, profitable. And we've been that. We weren't at first. We made some huge mistakes because we didn't know any better. But without saying the company's names, because I don't know that they'd want me to, but I can give you some examples. We invested in a software company that was basically disrupting a certain segment of trust and compliance business. And, it was an honor to be in on this deal. It was a very hot deal out of the Midwest. And we 12x'd our position in that in a little under 2 years. And so it wasn't just the 12x, because, we probably have some numbers that are bigger than that, but it was the speed with which it happened that was extraordinary at the time. And that was so early in our fund's life cycle. The reason I like that one for success is it allowed me to show people this is possible, right? And you don't just put your money, it doesn't matter, what publicly traded company it is. You don't put money in publicly traded stocks and 12x them, right? I mean, you have a company go, even in a big up year, if you made 50, 60%, which would be extraordinary, that's less than 2x, right? So
less than 1x.
Yeah. So there's this, this extraordinarily impactful, hits that these made. And so that was one interesting one. And then we had another early one. I got two others that I think are really kind of interesting without giving the company's names away. We did have a unicorn in our first portfolio. So a company that was valued at $1 billion.
Mm-hmm.
And we learned, listen, being on the other side of the newspaper clippings, it isn't always what it's cracked up to be. And, that's the top of the roller coaster, the top of the mountain. But in between where we started and how we ended up at that valuation, it was like a roller coaster. And, in order to maximize value, I think you need a VC or you need an experienced investor to bring you along that. But that's a pretty cool logo, to have. That was another software company. But one of my favorite deals is when you get in early, and this is where I think the opportunity is for our firm, for a company outside of the Valley that maybe is perceived to be not futuristic enough, not innovative enough, right? But we had this company. It was a digital procurement solution in what was perceived as a slow growth retail industry. And we loved it. We loved the founder. And so we invested when the company was making about $150,000 a year. And we felt sort of stupid at first because no one invested with us. We were the only institutional investor. And, it's just kind of like you're out there and, you realize how naked you really are. But as it turned out, through some series of fortunate events in the world today, the company has revenue about $150 million. And so if you have revenue of $150 million, I'll let you do the math on whatever multiple you want to put on a digital platform to a revenue of $150 million. And when you're the only investor, the only institutional investor, that means your dilution isn't very much. And so that experience has been very rewarding to, I guess, from an ego standpoint, we saw something that no one else saw, or we were just damn lucky. I don't know that it matters. We did it.
Wow. It's the old adage, right? Better be lucky than good. But you'd like to take some credit for being good there too on the due diligence side.
It won't matter, right? People will give us credit when we don't deserve it, and people will also blame us for other things that we don't deserve. So you win some, you lose some.
I guess that kind of begs the question, how the hell do you do due diligence on these companies?
So here's what I'll say. So, early on, when I was an angel investor before we had an institutional fund. And I was just trying to learn that question. Like, what people say, well, this is subject to full due diligence, or we need to start due diligence, or let's put together a due diligence package. And it was really confusing to me. Like, what does that mean? Like, what does that look like? And it does look different to lots of different people. And it's also different based on stage. But if we're talking early stage companies that have less than 10 million in revenue and haven't certainly found product market fit yet, then in my opinion, all the KPIs, all the things around revenue and financing, and even things around product, I think you can throw out the door because it's all going to change. But here's the thing. Almost everyone I know diligence the crap out of these pro formas. And or you've got these, I live in Cincinnati, and so, Procter & Gamble's like, the most important company we have. And I feel like, you just go outside and throw a stone and you're going to hit three former P&Gers. And those type of people love to talk marketing, distribution, and product, okay? But here's what I found out. The only thing that matters other than luck is the founder or the founders and the founding team. We've had companies that turned out to be terrible companies, terrible idea, with great founders and teams, and they return a profit to us. And we've had companies that are extraordinarily smart, good ideas, and really should be huge hits that turn into complete failures because of the founders. And so I started to think, well, if the founder and the teams matter, well, then where's all the psychologists doing due diligence? How do we know that these people are even capable? How do we know that they can handle the stress? When you're the entrepreneur of anything, running a restaurant, it's stressful. But when you're the entrepreneur that takes money from friends, family, fools, angels, VCs, whatever, and you're expected to scale this thing to multi-millions of dollars, it's a whole different pressure cooker. And it takes a special person to be a founder. But what are we doing to even diligence that founder? Nothing. Nobody's doing anything. And so we wanted to create as much assessments, interviews, and, any sort of rigor and diligence around the founder and themselves. And so we really leaned in on industrial psychology and psychometric assessments and just getting to the heart of what makes the founder tick. What are their natural born behaviors? Because behaviors are predictable. And when you're under stress, you will revert to your natural born behaviors. And so we shouldn't be surprised when a founder behaves in a certain way, when we could have assessed that and we could have predicted that. And the beautiful thing about industrial psychology is it's actually built on mathematics. I didn't know this until I started doing it. This isn't I didn't either. It's not psychiatry. This is basically assessing. There's tons of ways to provide an assessment, but you might get some sort of underlying scoring rubric. And if you took an assessment and I took an assessment, it would compare our answers. Well, if we extrapolate that out thousands of times, then I could look at Derek and I could look at Brad and I could say, well, in this one attribute, Derek is well above the mean. Brad is well below the mean. And then as VCs, I could decide, do I care about that or not? So we use that and we started tracking the data, which is sort of how we became an AI VC. And there was a lot of eye-opening moments. But what we loved about it is people are the first data point. The first thing you have at a company is a founder. So I decided that we wanted to know more about founders and co-founders than anyone in the world. And that's what we set out to do. And that's how we do. That's our primary due diligence. I mean, there's a lot of other boring stuff, but I thought that was more interesting for your,
there's a whole lot of other boring stuff in there, like math and KPIs and legal. Yeah, lots of fun stuff. So I guess, you've mentioned a couple of times, utilizing AI. So how do you utilize AI? Do you utilize it in the diligence of the founder? Do you utilize it in the analyzing of, the deal itself? How is AI portioning this?
So first off, when we started using AI, it wasn't cool. Like I was made fun of. People said, you're full of shit. Or I was made fun of on Twitter. everyone's got Shark Tank in their head, and it's like everybody wants to be Mark Cuban or Mr. Wonderful, and you have to pitch them. I haven't seen a pitch since 2018. So we didn't mean to do this. It was out of necessity. You led off the session and introed me from Kentucky. Like, do you know met? Right. So exactly. Nowhere. All right. I love Kentucky. I went to college at the University of Kentucky. Our grass is blue. We have bourbon and all that stuff, but nobody knows where we are. Okay. Like, unless you're from here, you don't know. You just don't know. So if I hung a sign and I was a retail shop and said, hey, I've got, $100 million, come pitch me. Nobody's showing up. We're far away. Okay. We're far away. And so in order to get access to founders, particularly as they were getting younger, is we wanted to be a digital solution. This is pre-COVID. Okay. And so it wasn't to be cool. It wasn't to capitalize on current tech or current trends. It was literally a logistics problem. We called it the $1 million mile problem, is I couldn't get to the founders to pitch me. I didn't want to drive a bus all across, 100 different cities. That's not reasonable. Again, they're not going to fly to meet me. We're not, I'm not Sequoia. I'm not Mark Andreessen. So we had to meet them where they're at. And where they were is on their phones.
Yep.
And so if we had a digital solution that anyone could access anytime, 24/7, 365, with just an internet connection, I knew we had a shot to get deal flow. So that's how we became a digital VC. And it went about as well as you expected. It went terrible. It did. It was, it was because what these founders were all trained to pitch. And so it felt they were like betrayed. I moved the cheese and I was putting them through a process that was so unique. They didn't feel seen, right? They didn't feel heard. They wanted me to read their pitch deck. They wanted to pitch me. They wanted to get on the phone. They wanted to influence me, and we didn't allow any of that to happen. So it went kind of bad. But then something extraordinary happened, and it's COVID. So no matter where,
the blessing in disguise.
That's right. So no matter where you are on, what COVID was from a health pandemic, it was a digital revolution for everyone. I mean, let's look at this podcast.
Right.
We're not in the same room. Right.
No. We're hundreds of miles away.
And this is normal. This is normal. And that's what COVID did, was bring digital solutions into normalcy. And I could argue in many cases, most people prefer digital, work from home, work, whatever. And so
you have no idea what I'm wearing from the waist down right now.
Nothing. No.
Oh, you do know, because you're probably doing the same thing.
Yeah, right. Of course. Like,
it's hot. It's hot.
So like all of a sudden, we went from like 14 to 20 deal opportunities, and they all sucked anyways, a month, to 200. And so if you remember in the spring of COVID 2020, the legal world was shutting down. And venture capital was no different. I mean, it was over. And there were no new financings going on. And people were doing, triage of their own portfolio. And founders couldn't get a meeting. So they looked everywhere. And that included the cloud. And we were there. And so we had an opportunity, to do deals in states and cities that we hadn't even spent a penny marketing on. Fast forward, 4 years later, and like I said, this has become like a new norm. So once we were in the digital realm and we were deploying these assessments, then we were getting an extraordinary amount of data. And so we were like, well, we should do something with this data, right? Because the human brain, we're all biased. We think we know. So we brought on a Moneyball person that was working in Major League Baseball and also had a computer science background. He happened to be my neighbor. And we said, hey, we've got all this data. Can you turn it into an algorithm so we can Moneyball founders based on their high potential psychometric scores? And that's what we did. So we were using what I call old school AI, which is definitely AI, which is machine learning. And the advantage of machine learning versus the AI that we often talk about today, which is large language models, is the computational power of machine learning is unrivaled. And it can take data in real time and continuously update its algorithms and its performance. So every day, I don't have to go back and rewrite my code or do something like that. As our AI bot, whose name is Wendell lives in the cloud. Wendell never sleeps. Wendell's immune to human viruses, and Wendell memorizes everything you tell it. But as that new data comes in, I mean, I guarantee you, people talking to Wendell right now, I'm talking to you. We have founders talking to Wendell. And as that data comes in, Wendell gets smarter. And we just run it up against the machine learning platforms. And so we use it to make faster, smarter decisions. Now, fast forward to today, I feel so fortunate to have lucked into, to solve a problem, a digital platform. LLM is like all the rage. So we do use LLM now, but we use it on the back end in a really weird way. We're launching, we're pre-effective now. We expect to go have a 40 Act mutual fund, receive approval for effective registration actually on Monday.
For a consumer product.
Yeah.
Okay.
Sold through advisors to solve all the problems, the K1s, the non-accredited. But we use AI to help us with valuations and to meet our audit requirements. So we'll have a daily NAV. And what we did was we trained AI off of AICPA documentation, which is like 600-something pages, and our own internal valuation models and policies, which is like 50 pages. And it helps us just ask it, what should we do? When we get new information about a company, what's the valuation method that we should take? Why should we take it? What information do we need to gather? And so that way, we're very structured and process-oriented to make sure we can meet our audit requirements. And I don't know that would have been possible, just 3 years ago.
Right. You'd have to have a team of 20 just to deal with that.
That's right. And then your fees will go up and you couldn't launch a mutual fund. So whether it's on the front end through the predictive analytics screening process, or whether it's back end helping us set our daily NAVs and meet our audit documentation requirements, again, this technology has allowed me to fulfill the dream of what I wanted to do. And now I'm not an advisor, but I can bring it to other advisors is, look, I can bring you a convenient, low cost, easy access point to offer venture capital across your entire book of business, period.
Yeah. And wait, is the ticker symbol going to be WENDL?
No. I like our ticker symbol though. It's VCAFX. So our fund will be called the Kinetic Venture Capital Access Fund. So VCAF Venture Capital Access Fund. Some people say AF means other stuff. I think venture capital is cool AF too, but
yeah, it is cool AF.
It is. Venture is amazing. It's everybody needs them some.
Yeah, it's in my career, I'm always kind of people are like, oh, where should we put money, blah blah blah. I'm like, well, there's cookie cutter portfolio or whatever, dividend portfolio, whatever. But it's like the real money is made in the private world, private sector. So it's like I get deals across my desk, probably multiple monthly. I don't know if it's on a weekly basis, but hey, boom, private fund this, just private deal XYZ. Hey, this construction company is for sale, this plumbing company is for sale, this HVAC company is for sale, and it's like, okay, how do you due diligence that? It's like, okay, who owns it now? How did they get there? What did they do? We have the same, I think, philosophy there. It's more about the people per se than it is. I mean, the numbers are important, don't get me wrong, but the people are the most important part there. And I guess that probably parlays into the next line of questioning here is like, okay, you've kind of innovated this stuff along the way. You've had, a lot of massive successes, even a unicorn or two in there. What in the world taught you how, maybe taught the right word or wrong word? What major mistakes kind of molded your philosophy and business model to do this?
Tons. I mean, first off, we're VC in Kentucky. Okay. So
Where?
I can address the first. Who taught? What taught? Nobody taught. There are no VCs here. Okay. This isn't the Valley. And if you think about it, well, why does our model look so different? Because we're not traditional. And so if I was born in California or born in Boston or went to college there or got a job there and I learned from other VCs, then I would expect that my business model would be similar because I hope it's working for them. Okay. It probably is. But if I built the same business model in Kentucky, I'm going to fail miserably. So one, we weren't taught, and that goes into, why is it so different? And then two, it's just a series of failures. So, failures in the scientific community are considered successes because when you're trying to create, some formula or something, and you've got 1,000 different hypotheses of what this formula could be, you got to check a few off the box. But in the Midwest, failure's been like, whoa, you have it totally wrong. Look, we just took the mindset of we're going to figure it out. We're going to have failures along the way. So like early on, one of the failures I already mentioned was deal flow.
Yeah.
So literally, we had this investment thesis. It was silly. It was called Cherry on the Top. And we live in the tri-state. Even though I live in Kentucky, and our office is in Kentucky, it's in the northernmost city, Covington, which sits on the river connected to a bridge to Cincinnati, which is our major metropolitan center. But a little bit to the west is the state of Indiana. So if you look on a map, they touch each other, right? In this upside down Y, it's called the tri-state. And the idea was, well, being in the tri-state, then let's really focus on getting deal flow from Indiana, Ohio, and Kentucky. And that means we have 3 times as much opportunity as just Ohioans or just Kentucky or Indiana. Well, guess what? 3 times those 3 states isn't enough. It is not. So
like Y of 0 is still 0.
it's not good. So it's just not enough to build a portfolio. Okay. It's not, there's a great states, great entrepreneurs in those states, but it's not enough to build a diversified mutual fund. And so as soon as we knew that, we put our pencil to the paper, we knew how many deals were getting done in the Valley. We knew how many deals were getting done in Boston and New York, but you can't compete there. So check those off. Well, what did we need? Rest of country, or rest of North America. And that created the logistics problem, right? Which we had no money, we had no people, and that's what created, the digital bot, which again, epically failed because nobody wanted to do it. But COVID happened, and we got lucky that we were right there. And then not just predictive analytics, but LLM AI models came on the scene. I didn't have to develop a new platform. I already had a platform. We plugged it in. We had our predictive analytics. Now we plugged in the LLM. Wendell just kept getting smarter. And so, we just continued to luck out. And all of those sort of evolved our models. There's tons of like little nuance things that, you can talk about, what type of security interest do you take? Did you learn stuff from that? We did. That's always changing, safes and notes and common stock and preferred stock, and what terms do you like? And do you take board seats? And look, all of that is constant state of flux, and all of it, you're always challenged on, do we change our beliefs because this happened on this one case, or is that recency bias? And, but who we are today is, look, we're just trying to do the things that seem like makes sense intuitively, plus the data supports that, do more of it, and we want to keep evolving off of failed experiments, in order to, solve new problems that we have.
Sure. So what's, it sounds like it's a very kind of intuitive and ingenious platform. So first of all, does Wendell stand for anything?
No. So look, I told you it was my neighbor. And again, that's good fortune that your neighbor, knows a little bit about data analytics from the baseball world and also happens to be a software developer. But here's the really good fortune. My neighbor really liked bourbon. And so had I just pitched this idea straight up when he had a really good job, it wouldn't have worked. But I got him drunk, and he's at my kitchen table. He is. And he's like got his little laptop, and I'm just spouting off what I want Wendell to do. It wasn't named Wendell yet. And he's just coding, and he's drinking. He's enjoying his Elijah Craig 18 year. He's having a good time. And at the end of the night, as we got drunker and drunker, we're like, I think we need to name this bot we're building something. It needs to come alive. And he's like, I really always liked that song by Arrested Development, Mr. Wendell. And so he goes on his way, and I stay up a little longer, and I get on, the Kentucky and Delaware, websites, and I look it up, and Wendell is available. What's funny is the reason it's available is I misspelled it in the sense of like the male name. If your name is Wendell, it's W-E-N-D-E-L or W-E-N-D-L-L. And I didn't know it at the time, but I just spelled it W-E-N-D-A-L. Had I spelled it the correct way, it wasn't available, but I misspelled it. And, I sent him a text. He was snoring, but by the time he woke up the next afternoon, he had looked in his inbox, and I said, Joe, Wendell's alive. And that was it, because he liked some song.
That's funny. And Elijah Craig, 18 year. Good choice, by the way.
That's how I got him, His wife's like, you better come home soon. And I'm like, 18 year, stay a little longer.
So it's, Joe's and my wife probably are the same. They don't understand that, like, cocktails and golf go along with deals and,
yes.
business. It's like, that's a part of it. It's part of the equation. You have to be okay with doing that.
Absolutely.
Unless you've got just the most ridiculous sense of humor and personality in the history of the world, which I don't think either of us are lacking in. But so what do you see kind of as what are your biggest struggles, kind of either whether it's looking backwards or moving forward? What's been the hardest part about creating and growing a VC firm in freaking Kentucky?
A couple of things have been really hard in general, and I think that could be specific to our journey or just really hard with companies. I don't think in this day and age people are very patient.
No.
I have this, I'm lucky. I come from a long line of entrepreneurs. So you might say it's in my DNA, and that I'm just lucky to have that. But, my dad IPO'd a company. But the thing of it was, from the time my dad founded the company to IPO to sale, it was something like 24 years. 24 years.
That's a career.
You think? Nobody bitched the whole time. And because times were different, and he was doing something that people understood. I think venture capital is extraordinarily new to a culture here in the Midwest that is probably not known for risk taking. Yeah. And so, just explaining, it doesn't matter. No one's listening. If I say, it's 9 to 12 years, which is what I said, and you won't see anything for 6. Well, in 6 months, they're like, hey, where's my return? And so that was very challenging to over communicate. And you just have to have so many more, I did anyways, touch points with my customers, my investors, to keep them on the train, during what has been an extraordinarily long process. And venture is getting longer. I mean, you can pull any statistic, and companies are staying private longer. It's taken, longer to exit or IPO. And there's lots of reasons for that, but it's a really long, arduous slog. So, that's been really difficult. And the other thing that has been kind of painful is it's my fault. We're so crazy. We're not just venture, which is new. It would be so much easier if I just said, hey, look at these successful firms in California. We're doing it the exact same way because it's tried and true, which would have been an easier story. I would have simply said, Kentucky needs a VC. We're as smart as them. We're Kentuckians. We can do it. We would fail miserably, as I already went through. You can't. They've been around since the 70s and 80s, okay? Like, their model works for them. It won't work for us. Here's another Do you have $2 billion to give me? Because that's what they have, or $9 billion or whatever. Like, you can't even compare the two. But evangelizing, or getting people to realize that our business model is we've just been solving problems, really, to me, makes some sense. And that has been difficult because most of the ecosystem is really built off of a chassis that was built on the coast, which I don't see any evidence that that's working here.
Right.
So that's been really hard to just we're like the island of misfits. We're just different.
What about looking forward? Obviously you got lucky along the way, had a lot of perseverance. You made some good decisions and some bad ones. Looking forward, kind of what do you see, Kinetic Ventures looking like in, the next year or 2 years, whatever time frame you want to look forward. And, what pieces do you have to iron out to get there?
Well, I think we can be America's next great mutual fund company. I mean, okay. Most funds and asset managers, probably started in a garage, and we're in an old piano warehouse, and we have a superpower, and its name is Wendell. And so we're on that cutting edge of, a human hybrid intelligence platform where we can do things to bring new strategies to advisors to offer alpha to their clients or access to private markets that, quite frankly, you don't have. If you look at all the solutions, I know them well. I'm not a wholesaler. I'm a certified financial planner that had a independent investment advisory practice. And so if you look at all the solutions, they're like piecemeal, broken solutions to get access to private markets, whether you're buying secondaries. I could go on about why that may not be a good price indicator, or your feeder funds, or your fund of funds, or your special purpose vehicles, all of which lack transparency, require Hyman-Ohms accreditations, and they're non-diversified. These are just everyone's current sort of brainwaves on how to do it. We are pure play venture capital. We are doing initial financing rounds of buying stock in private companies that will be, the future, S&P 500 of tomorrow. So, and I think we also, from a platform standpoint, we could probably look, that's one strategy, but what's to stop me now from bringing other emerging managers to every household in America?
Yep.
And I think that's important that, we can do it. However, good friend of mine said it, Brad, not the best companies, the best products don't always win. And so I think really focusing on brand, and, really driving home, my background and my team's background, being in the wealth advisory service. I'm going to walk in, Derek, and whatever problem or whatever is on your mind about your book of business, I care about.
You've been there.
I've been there, and I care about financial advisors. I like the service. I'm not a robo guy. I like the service because money is personal. Right?
Just like health. Money and health, the two big ones.
It is personal. And every situation is very custom. And so financial advisors provide this great service. And so if I can, provide a product that helps solve a problem that these advisors have, or increases the value, as an access point to the financial, world that these advisors bring to their customers. Look, I'm really excited about that. And quite frankly, I think we have a right to win. Because who else is going to be able to look you in the eye the way I do and say, right, I know what you're going through. And, I created this product for an advisor like me to say yes to. And so I'm really excited about partnering and just going back to my tribe. I miss parts of the business. And so I want to be around it.
I like the idea. So I guess, to start kind of closing things out here, if there's people who want to be either whatever type of entrepreneur, but specifically an entrepreneur in the VC space, what advice would you give somebody who's looking to either enter that space or just enter the entrepreneur space in general?
Number one, I would network nationally. This was a concept or an activity that it didn't really cross my mind until I was in the venture space. And then it didn't even cross my mind until we evolved and needed to do deals nationally, or I had the opportunity to do Zooms and Teams meetings like this. You'll be surprised at how sort of one or two trick mindset your hometown is. Even if it's a decent size, you've really got to get out and spend time and just get, a more worldly perspective, and just build more contacts and grow that network nationally. I mean, I don't think you need to go to some chamber dinner, 20 years in a row in your hometown. Like, look, I would take the weekend off and go to Chicago or New York or Louisville or, Atlanta, wherever. It doesn't matter. Just go and build that network nationally. That is so helpful, valuable, and interesting. And it's crazy. Like, some of I guess I'd call them my new best friends, because I trust them. And my most interesting characters that are allies are all spread all across the United States of America these days. And that's because I networked nationally. That's number one, what I would say. And number two, you just have to be authentically you. I think I also was authentically me too late in life. I was just when you're young, you just want to make everyone happy. You want to fit in, you just...
Worried about what people think about you.
It's really tough. And then your authentic voice doesn't come out, and you're just upset inside. And I don't know, being an entrepreneur, I do think it's an opportunity for you to step outside of wherever you work today and craft something that's uniquely you, and where you're the king or queen of the castle and the kingdom. And, I just think you'll be happier that if you do it your way. And so that's how we became this quirky, powered by Wendell, digital, VC that believes in psychometric assessments based on industrial psychology.
Yeah.
That's just made sense to us. And so there's a lot. I love entrepreneurship and I love entrepreneurs, but those are two that I think are tangible, actionable, that anybody listening can do.
All right. Well, so how can people find out more about Kinetic Ventures, about the mutual fund? Well, I guess the mutual fund technically is not coming out until, in theory, Monday, but how can people get in touch with you and learn more about Kinetic Ventures and potentially the mutual fund?
Hit us up. Hit me up on LinkedIn. I'm pretty active there. And we can always swap further contact information there. That's how you get in contact with me. If you want to learn about my venture capital firm, the advisor, go to our website. And then anytime after Monday or Tuesday, we'll have another link to the website that will be specific to VCAFX. Once it goes post-effective, you should be able to, invest. You should be able to, download the prospectus, show your financial advisor. But everything will be all online, and we're, pretty responsive.
Are you going to have direct investment availability, or does it have to go through a custodian of some sort?
No, direct, and, as you can imagine, it's not like day one. We have to go effective before the custodians will even talk to you. So the majority, all non-IRA investing day one will be direct. IRA investing week one will be on a self-directed IRA custodians. You would know them if I sat them. But then, my job is to get the advisors.
The dealers.
Yeah. Well,
to give you shelf space.
Yeah. They won't listen to me, but they'll listen to the advisors, right? And so when the advisors, look, this is an asset capturing tool, right? Right now, I have all your money direct. You can have it back for free, and you can charge your fee on it. So I need to drive to Banff to the advisors. The advisors can call the Schwabs, Fidelities, Axos, Pershings, LPL, Rajays, whoever, and say, look, we need this on platform. This is not at all. This is a 40 Act effective, product. And then we'll do that. There's also a really cool data feed we have through a new data provider called AltExchange. AltExchange is a digital custodian. It allows us to report. If you want all your clients to have access to your fund, you want it to flow through whatever billing or quarterly performance software at our cost, totally free to the advisor. We can use AltExchange and send you perfect data feeds on all your clients.
Open APIs would be wonderful. That's one struggle that I hate right now, coming from, TD as a custodian to somebody else. It's just like TD had an open API that I can connect anything.
Yes.
And now it's like, oh, we're on a MS-DOS platform, essentially, is what anything else is besides TD. It's like dealing with MS-DOS.
I know a lot of those TD guys went over to Axos. So if you haven't checked them out, you might want to.
I'm already there.
Oh, okay.
But they are an MS-DOS platform right now.
Uh-huh.
I mean, it's like, it is, but that's everybody. TD, like, I had no idea that I chose the right one when I chose TD as a custodian. It was like, okay.
Isn't that sad? I mean, that's sad that how the loyalty and how much love every advisor I've talked to, missed the TD days. I mean, it's pretty extraordinary.
Yeah. And, I'm not even going to get into Schwab because they're a bigger dumpster fire than one of the broker dealers I worked for back in the day. So, anywho, all right. Well, as you know, my name is Derek Delomo. I'm the owner of both Tremonti Financial Consultants and Tremonti Tax Solutions, together referred to as Tremonti. Tremonti bridges the gap between financial advisors and accountants by serving as CFO to our clients. We specifically love to work with business owners to develop a proactive tax strategy that maximizes after-tax profits. It's our job to help you earn more, be more efficient, grow faster, and pay as little in taxes as legally possible. If this idea piques your interest, please go to TremontiTax.com and click on the 15-minute schedule now button to book a 15-minute chat with me. Whether we end up working together or not, I'd love to hear from you. With all that said, Brad, it was really good talking to you today. I really enjoyed hearing about Kinetic Ventures and the new mutual fund, which I am interested in. For those of you listening, if you enjoyed today's episode and got a few helpful takeaways, we would love for you to leave us a review on Apple Podcasts and share this episode with other business-minded friends. This has been another episode of the Traversing Entrepreneurship podcast. We had fun today and hope you did too. Thanks again, Brad, for being here, and thank you for tuning in and listening.
This podcast is presented by Tremonti Financial Consultants, LLC. The firm is registered as an investment advisor and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor does not constitute an endorsement of the firm by securities regulators, nor does it indicate that the advisor has attained a particular level of skill or ability. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. You should consult with a professional advisor before implementing any of the strategies discussed. Content should not be viewed as an offer to buy or sell any of the securities mentioned or as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment or strategy will be suitable or profitable for an investor's portfolio. There are no assurances that a portfolio will match or exceed any particular benchmark. All investment strategies can result in profit or loss.